Okay, today we want to finish looking at our itemized deductions. In our last session, we had stopped at miscellaneous deductions. So I want to look at the Schedule A and see where they fit on the Schedule A. At the bottom, you have job expenses and certain miscellaneous deductions. So we're going to cover those. And then we have other miscellaneous deductions. And we will look at those. The difference between this section of miscellaneous deductions and the ones that appear under other is that these are limited to 2% of your AGI, and we'll look at those. And so we want to go to our miscellaneous deductions, and as we began last time, that we have some that are limited to 2% of your adjusted gross income, and then we have some that have no limit. We began looking at unreimbursed employee business expenses, and then employee business expenses that were reimbursed from a non-accountable plan. And unreimbursed employee business expenses are those expenses that are legitimate employee business expenses that I incur that my job doesn't reimburse me for. So therefore, I can take them on miscellaneous on my Schedule A. And then we have those that are reimbursed, but they're reimbursed from a non-accountable plan. And I was explaining the difference between an accountable plan versus a non-accountable plan. The accountable plan is one in which my employer reimburses me, and I have to account for all the expenses that they reimburse me for. I have to provide receipts, and so I have to be accountable for it. A non-accountable plan is a situation where the employer does not hold you accountable for that. They provide the money, $5,000 for a week conference in California, and they provide the money, but you do not have to account for it. So given that, they're going to take that $5,000 in that non-accountable plan, put it in income, and then make you deduct the expenses from Schedule A, from Schedule A under miscellaneous. An accountable plan, someone attending the same conference, $5,000, they are going to have to account for the $5,000, their hotel receipts, meals, a per diem amount a day, and they have to account for that back to the employer. If for some reason they don't spend it all, they give the amount they back to them that they didn't spend. In that instance, no amount of that $5,000 goes into income, and you cannot take the deduction. So that's the difference between those non-accountable and accountable plans. Okay, also, the other expenses that are part of this 2% limitation is the investment expense. If you recall, when we talked about taking a deduction for investment interest, we talked about investment expenses that go along with that. Now, this deduction for investment expenses is going to be limited to net investment income. So you can deduct the expenses related to, like perhaps there's some fees that the broker may charge or something like that. So there's some investment expenses that you may deduct. And then we have tax return preparation fees that you can deduct. And also included in that is electronic filing fees. So if you have to pay a fee to file your return electronically, then you can also add that or include that as a deduction here. So tax return prep fee, including the electronic filing fee. And then also is your job hunting expenses. You can deduct expenses for job hunting. Now, there are some rules or some limitations to that. It's for when you are seeking employment in your current field. So we'll say in your current field. So I'm an accountant. I can't seek employment as a nurse and get the job hunting expense deduction. And then the deductions that you can deduct, the costs that you can deduct, include any travel that you may incur, and that's out-of-state travel as well. And then also any employment agency fees. If you employ an employment agency to help you find a job, you can deduct those as well. Now, you have to be careful that this is not allowed, this job hunting is not allowed for first-time job seekers. Okay, so if I'm fresh out of college, looking for my first job, this wouldn't apply to me. Okay, and then also if you are looking for a job in a new trade or business, if I'm changing jobs or changing fields. Now, if I am looking for a job in my current field, then I can deduct those expenses. Also, they talk about continuity. You can't be out of work, go back to school, and then look for a job, and it's deductible. So it has to be continuity in it. You know, you out of work, and you continue to look for a job. Forget those job hunting expenses. Now, keep in mind that all these expenses, the investment expense is limited to 2% of your AGI. Tax prep, job hunting, all those are limited to 2% of your adjusted gross income. Also, if we look back there on that handout, the union dues will go there. A lot of people deduct their union dues. Your safe deposit box may go there. All those other type of miscellaneous deductible expenses are you can take there. Some of the expenses are legal fees and accounting fees, any other legal and accounting fees that you may have. Your custodial fees, maybe on like I said, on your investments. Job-wise, small safety equipment like your safety shoes, small tools and things you may have to get for your job. Any other supplies you may need for your job. Uniforms required by your employer that are not suitable for ordinary wear. So if I have to have a particular uniform, it doesn't mean the khaki pants and the white shirt. If I have to pay for the white shirt with the company insignia on it, then that's going to be a uniform. Cleaning of uniforms is deductible. Protective clothing required, hard hat, safety shoes, those type of things. If you have to get a physical exam, dues to professional organizations can be deducted there. Subscriptions to professional magazines can be deducted there. So there's a lot of items that you can't take personal legal expenses. You can't take political contributions, lost or misplaced cash or property, expenses for meals during your regular work hours or extra work hours, the cost of entertaining friends. These type of things are not deductible. If you look in your Pub 17, they give you a list as well as in your book. So all those items would be included. The employee business expenses you would fill out, and this may be too small for you to see, a 2106 form to do that. And then the other items would go here. We have a line specifically for tax prep fees and then other expenses. You're going to add up those total expenses. You're going to take 2% of your AGI, and then whatever's in excess of 2% of your AGI is what you end up being able to take. Okay. Now, the other line item your other miscellaneous deduction that has no limit is the big one I'm thinking of now is your gambling winnings. I'm sorry, gambling losses. Go here. Now, but you can only take those to the extent of your gambling winnings that's going to be reported on the front of your W-2. So if you have, not on the front of your W-2, but on the front of your 1040. So if you have gambling winnings of $10,000, and as long as you had verification of gambling losses up to $10,000, you can deduct gambling losses on your Schedule A, and they would not be subject to 2% of your AGI. So you can take gambling losses up to your gambling winnings. Gambling losses up to your gambling winnings, okay? A lot of people assume you can take all your losses. You cannot. You can only take those that are up to your winnings, okay? Other items you can take: casualty and theft losses of income-producing property, and then losses from other activities from Schedule K-1, federal estate tax on income respect of a decedent, amortizable bond premiums, deduction of repayment of amounts under a claim of right of over $3,000, certain unrecovered investments and pensions, and impairment-related work expenses of a disabled person. So once again, if you look at your Pub 17, do a search on IRS.gov. They'll give you more items and more possibilities that's listed in the book for your miscellaneous deductions. Okay, so that covers all our miscellaneous deductions. And so for Schedule A, what we've done is we've started off by looking at our medical. We looked at taxes that you paid, interest that was paid, charitable contributions, your casualty and theft losses, and then your other miscellaneous deductions. And so then that gets you down to your total itemized deductions. Now, something I want to blow up and bring to your attention, it has a statement down here. It's Form 1040, line 38, over $159,950 or $79,975 if you're married filing separately. And so you have to check the box no or yes. Given that, then it's a possibility, if it's yes, then a portion of your itemized deductions are going to be phased out. You're not going to get the full amount. So if this totals up to $50,000 and you have $200,000 worth of AGI, then what's going to happen is that you're not going to get all of yours. It's going to be phased out. So we want to look at that phasing out of your itemized deductions. And at the same time, we're going to look at the phase out of your exemptions amounts as well. So we want to start off by looking at the phase out of your itemized deductions. Okay, and this is in your book as well. Let me get you to the correct page. It starts on page 521. Okay, and we will cover both of those. Okay, now keep in mind we're going to go through these detailed calculations so that you can understand what's happening. But if you're doing your tax return via tax software, and I won't mention any because you have a lot of options out there, a lot of software online, a lot of software for you to purchase, so I won't necessarily promote any, even though with your textbook you did get tax cut. I will mention that, and that's some software that comes with your book that other people have to go and purchase, so that is a benefit. But any of those softwares are going to automatically make this calculation for you. So given that, we're going to go ahead and go through the calculations just so that you can understand how it works out. Okay, we have a threshold. We have a threshold or a top number that we're looking at. We're looking at that 159, as they said at the bottom, 159,950, or if you're married filing separately, if you have income over 79,975. So we're looking at those numbers, and that's your AGI. So they're saying if your AGI is more than that, then the reduction that you're going to incur is limited to 26 2/3%. Now, how do they determine these? I can't tell you that, but that's what it is. 23 2/3% of your itemized deductions. Okay, and not considering all your itemized deductions other than, meaning they're saying these particular ones are not subject to this limitation. And they're the medical, because notice they're already subject to one, but your investment interests, they say it's not. And casualty and theft losses, and any wagering. Okay, so given that those aren't subject to that, okay, so the reduction of the itemized deduction is 26 2/3% of your itemized deductions other than those particular ones. So it's basically is going to be limited to the 26 2/3%. It's the lesser of actually the 26 2/3% of that amount, or 1% over which your AGI is over the threshold, or 1% of the amount your AGI is over the threshold. Okay, and this is going to be the lesser of those two. Okay, the lesser of the two, and it's going to be represent your reduction. Your reduction is going to be that. So let's just look at one. If you look at the bottom of page 5-21, Francis and Marcia are married taxpayers who file a joint income tax return for 2008. In 2008, they had adjusted gross income of $180,000, an itemized deduction of $20,000. The itemized deductions are from charitable contributions and state income taxes. So that's not medical, investment, or casualty or wagering losses. So given that, then all of their casualties could very well, all of their itemized deductions could be reduced. Okay, so they had 180. They had an AGI of 180,000, and then we're going to compare that to the threshold. The threshold was 159,950. Okay, 159,950. So if I take the 159, and even though this calculation's in the book, it's okay for us to do this again just so you can see it. We will do a problem in the back of the book looking at both of the limitations that we have. So 180,000 minus 59,950 gives us 20,050, and 1% of that is $201. 1% of that is $201, and then we're going to take the itemized deductions. They had 20,000 in itemized deduction, and we're going to multiply it times 26 2/3%. We're going to multiply it times 26 2/3%. And when we do that, we get $5,333. We're going to take the lesser of the two. And then you take your itemized deductions of 20,000, and it's going to be reduced by the lesser of the two. So therefore, $19,799 represents the amount that they can deduct for itemized deductions. So theirs end up being reduced by $201. So that is the limitation on itemized deductions. That is the limitation on itemized deductions. If we look at the top of page 522, we'll just read through this example. They have another one here using the same facts in the preceding one, but assume that income is $360,000, so it's a lot larger. Income's $360,000, and the itemized deduction consists of $18,000 in casualty losses after the $100 floor and after applying the 10% of adjusted gross income limitations, and $2,000 in state income taxes. So because of the casualty losses not being subject to this reduction, the only thing we're going to consider is the $2,000 of the income taxes. This is the $2,000 of the income taxes. And actually, I do want to put that calculation here on the side. To me, it's a lot clearer. They do it in paragraph form in your book. So we had $360,000 of AGI. And remember, we want to say what is the excess over the threshold. So we take that number and subtract the threshold from it, and we get 200,050. And then we multiply that times 1%, and so we get $2,000. Okay, so we're going to compare that to the amount of itemized deductions that are subject to reduction. We take 2,000, because remember the casualty loss is not, times 26 2/3%, and we get 533. In this instance, this is the lower of the two. So their itemized deductions would be reduced by $533. So that is the phase out of your itemized deductions. Also, there's a worksheet that's on page 5-22 where you can go through line items and figure that out. But this is the basic calculation. Next, we want to look at the reduction in our exemption amount. So we want to look at the reduction of exemptions. Not only if we are high income taxpayers will our itemized deductions be reduced, but also our exemptions can be reduced as well. And I won't write those thresholds down, but we have threshold amounts that are on page 522. So look at page 522 for your thresholds. And it's based on the filing status. Single, for instance, is $159,950. Married filing jointly, $239,950. Married filing separate, $119,975. And head of household, $199,950. So we have those thresholds amounts, and they're different. Okay. Now the reduction in your itemized deduction, not itemized, your exemptions is going to be reduced by 1/3 of 2% for each 250, or $1,250 if it's married filing separately, or a fraction of your AGI that exceeds the threshold. Okay, and so with the maximum amount of reduction to be $1,167, meaning the most that they'll reduce your exemption by is $1,167. So you kind of read that and you're thinking, what? To me, it's kind of confusing. So let's read the example and then we will do one together. In 2008, I'm at the bottom of page 522. In 2008, Heather is a single taxpayer with adjusted gross income of $173,250. So she's single. The threshold for single is $159,950. So we already know she's over the threshold. She is entitled to one exemption, $350. Heather's exemption must be reduced by $140. And the way they got that is 12% times $3,050 times 1/3. Okay, so 12% times $350 times 1/3. Okay, and so the question was, how did you get the 12%? That was it just given, or where did that number come from? So that's the percentage that you have to come up with, and then that percentage is that 2% of every 250 of which are a fraction of which they exceed the threshold. Okay, so what we did was, and I'll do it just kind of on this corner, even though they have it there, you want to say, how much do I exceed the threshold by? So we want to start by taking her AGI. Move that over so you can see it. You want to start off by taking her AGI of $173,250 minus the threshold for single person. Okay, and then you get, let me get that number, they don't use it in the book, 159. Okay, you get 13,300, and then you want to divide it by 2,500. If she was married filing separately, we would divide it by 1,250. And so when we get that and we make that division divided by, you get 5.32. Okay, and the IRS says to round up, so we're going to use 6, and then we multiply that number times 2%, and so you get 12%. Okay, so then that's how we get that number. And so then we take 12% times her exemption amount, then we multiply it times 1/3. And so therefore, her reduction ends up being $140. We're going to reduce her exemptions by $140. Okay, on page 523, let's look at the self-study to do another problem that has to do with this. Self-study 5.7. Okay, it says Elvis and Greta are married taxpayers who file a joint income tax return for 2008. On their 2008 income tax return, they have adjusted gross income of $181,000 and total itemized deductions of $12,000. The itemized deductions consist of $5,000 in state income taxes and $7,000 in casualties. And then of the $12,000 itemized deductions, what amount is allowed as a deduction for calculating their taxable income? So we want to do two calculations. They don't ask me to, but we're going to do the calculation for the exemptions, just assuming it's the two of them, so they would get a $7,000, and then we'll go and do the also the one for the limitation of their itemized deductions. Okay, so for the exemption, they say that their AGI is 181, and it's probably, well, actually, it's probably because they are not over the limit. So 181, and if you're married filing separately, if you're married filing jointly, then the threshold is 239,950. So given that, you wouldn't be limited to any of your exemption amounts. You would get them all. Okay, we'll still do another problem that does that, but let's go ahead and do the itemized deduction one. Okay, let's do the itemized deduction one in this space that I have here. Their AGI is 181. And remember, for itemized deduction purposes, the threshold for married people is 159,950. Okay, given that, we have excess of 21,050. We're going to multiply that times 1%, and we get 211. We get 211. When you read through their itemized deductions, they had 12,000. They consisted of 5,000 in state income taxes, which would be subject to the reduction, 7,000 of casualty loss, which would not be subject to it. So the only thing that's going to be subject to it is the 5,000. Okay, we're going to multiply that times 26 2/3, and we get $1,333. And so we're going to take the smaller of the two. So we're going to reduce their itemized deductions by 211. They were not subject to a reduction in their exemptions because for married filing jointly, the threshold is 239,950. So they would be only. So sometimes you are subject to one of the reductions, but not necessarily subject to the other reduction. So that's important to know, that you're not always subject to both reductions, even though you may meet one. Okay. There is a problem in the back of the chapter that I want to do just one more to calculate this. I do stress that tax software generally is going to do it for you, but not always. I mean, you won't always have software. You may have to do it by hand, but most of the case that's not going to be the case. But anyway, we go through the process so that you'll understand. We're going to look at page 5-45, and let's look at 25, I believe is the one I want to look at. Okay, let me make sure this is the one that I want to do. There's two here, and I just want to, actually I'm going to end up doing both of them eventually, but it's whether this is the one I want to do right now. Okay, let's go ahead and do 25. Let's go ahead and do 25. That is the one I want to do. And this is actually a good one for this point of where we are as we finish up. Okay, problem. $25, and we are on page 5-45. 5-45. They start off, we have Jim and Martha, and the first thing they want us to do is come up with gross income. So we're going to be thinking about gross income as we read through this problem. Okay, Jim and Martha are married with 3 dependent children. They have a joint return for 2008. Their income is salaries, so salary is going to be included in gross income. and they received $10,000 in taxable interest. That's going to be included in gross income. And then they had $10,000 in taxable interest, $5,000 in royalties. That's going to be part of their gross income. And then $3,000 of other ordinary income. Okay, Jim and Martha's deductions for adjusted gross income amount to $3,200, and they have itemized deductions as such. So if I add the $210 plus the $10,000 plus the $5,000 plus the $3,000, that's going to give me gross income of $228,000. That's going to give me gross income of $228,000. Okay. Next, they asked us to come up with adjusted gross income. How do I come up with AGI? What is my AGI? They told us that we had one adjustment. They tell us that we only had one adjustment of $3,200 for adjustments to AGI. So I'm going to take the $3,200 and subtract that, and I get adjusted gross income of $224,800. So I get adjusted gross income of $224,800. So that's my AGI. Okay. Then next thing they want to know are itemized deductions and our standard deduction. Okay. So we want to calculate and figure out what is our itemized deductions. They tell us that we have itemized deduction totaling $24,500, and they consist of $20,000 in mortgage interest and $4,500 charitable contributions. All those amounts are subject to the reduction. So all the $24,500 is going to be subject to the reduction. So what I'm going to do is take the AGI of $224,800 and subtract that threshold of $159,950 is my threshold. And so $224,800 minus $159,950, and I get $64,850, and I'm going to multiply it by 1%, and I get $649. And I'm going to compare that to 26, multiply this times 26 2/3%, if you remember that calculation. And given that, let me multiply that. Okay, okay, so if I take 24,500 times 26 1/3%, I get 6,533. And remember, I'm going to take the lower of the two. Okay, so for C, my itemized deductions is going to be the 24,500 minus $649. So 24,500 minus 649 gives me itemized deductions of 23,851. Okay, so that's how we get that. And then next, they asked us for the number of exemptions in the deduction amount, the number of exemptions in the deduction amount. Okay. Once again, married, filing jointly, and I think they're still okay because our threshold for a reduction in your exemptions for married, filing jointly is $239,950. So once again, this is a problem that they're not limited to. Their exemptions, they're going to get them all. And I believe they had 4 or 5. We had Jim and Martha, and they had 3 dependents. So if we take our $3,500 times 5, the spouse and the 3 dependents, we get $17,500. So their deductions for exemption purposes is $17,500. Okay, and then next they want to know the taxable income. They want to know their taxable income. The taxable income is going to be the AGI of $224,800 minus the itemized deductions minus the exemption amounts, and you get taxable income of $183,449. That is your taxable income. So that's problem 25. Going through the calculations of how do we come up with gross income, come up with adjusted gross income, and then going through the calculation of how do we limit or come up with the reduction amount for our itemized deductions. Okay, let's also do 26. 26 is the problem that finally we get to practice on limiting the exemptions. On 26, we have Frank and Joyce. They're married and filed a joint tax return. They had salaries of $290, and they have taxable interest of $40,000. They have no deductions for adjusted gross income. Their itemized deductions are $4,000 in state income taxes, $5,000 in charitable contributions, and $15,000 in mortgage interest. Frank and Joyce do not have any dependents. What is their deduction for personal exemption? So we'll just do, and they actually want you to do the worksheet. So we'll do the calculations, and then I will show you the worksheet. Okay. So they had actually $290,000 of salaries plus $40,000 of interest income, taxable interest income. So they have $330,000 of taxable income. They don't indicate any adjustments to AGI. So therefore, we're going to assume the $330,000 is their AGI. Remember, the upper limit for your married, filing jointly taxpayers is $239,950. That's the upper limit for them. And so the difference between those two numbers, the $330,000 minus the $239,950, is $90,050. Is $90,050. Okay, so if we go back and look at our calculations, we want to take that number and divide it by 2,500, and then we get 36.02. Okay, we get 36.02. The IRS has us round up. No matter what that number is, they have us round that up. And so we ended up with 36.02. We're going to round it up to 37. And we're going to multiply it times 2%. And that is going to give us 74. That's going to give us 74. And so it looks like they have, it's them two, and they don't indicate any other, so it's just the two of them. So given that 3,500 times 2, they're going to get $7,000 of itemized deduction. So we're going to take the 74%, and we're going to multiply it times their exemptions of 7,000, and then we're going to multiply it times 1/3, not 1/2, 1/3, and see what we get. We get 7,000 times 74% times 1/3, and we get 1,726. We get 1,726 is the amount of the reduction that you can take for your itemized deductions. The amount of reduction that you can take for your itemized deductions. Now, if you recall, when I doing my calculations here, when I originally did the calculation, that there was a maximum amount. So let's see, if we take our 7,000 minus our 1,726, we would end up with 7,000 minus our 1,726. We would end up with a deduction of 5,274. 5,274. Okay. So that is what I show as the amount. I do not show, and I'm going to show you this while I look at something real quick. Let me show you that. That is the form. Let me blow it up a little bit. And that's the same number that we get on the form. Now let me check on that maximum amount and make sure I read that correctly. The maximum reduction in the exemption deduction is 1,167. And here we have 1,727. So according to what we read, the maximum amount that we would reduce our itemized deduction by is 1,167. Now the question is that per exemption? And that is. So that is why we can reduce it by the 1,727, because the maximum amount is 1,167 per exemption. Okay, I was concerned about that amount because I knew there was a maximum amount, but it's not a maximum overall reduction. It's a maximum per exemption. In this case, if we took 1727 and we divided it by 2, we would be reducing each exemption by $863.50. And so we are well below the maximum per exemption amount. You get $3,500 per exemption, and so the maximum that we can reduce per exemption would be 1,167. So we didn't meet that maximum amount. Okay, so you can do it by the chart, or you can do it through the calculations of which I just showed you. So either way, that is how you come up with the calculation. But as I said, the good thing about it is that in reality, your tax software is going to have to do it for you, and so you would not have to. Okay. That takes care of our itemized deductions, everything that goes on Schedule A. There's a few other things in this chapter that we want to pick up and look at, and we start off with moving expenses. Moving expenses, we're going to look at those, and then we will look at the education expenses that follow. Okay, so the moving expenses is the next thing that we want to look at, and the possibility of being able to deduct our moving expenses. You can deduct moving expenses. So there's a lot of deductions out there in which we can take. Now the moving expenses are, as I said, not a Schedule A, but they are a deduction for AGI. And if you look right here, line 26 there is moving expenses, and you need to do a form 3903. So that is where we deduct moving expenses. So they're not limited to 2% of your AGI. There's no special limitations there. They are a straight deduction from your gross income, which is an excellent and good deduction. They're a straight deduction from your adjusted gross income. So let's look at our moving expenses. There's 3 tests that must be met for moving expenses, and we're going to look at those tests. But when we talk about moving expenses, we are referring to the actual travel costs, because when you move, you have to actually travel. If you have a drive or something that requires lodging, or a situation that requires lodging. And then also we're talking about moving household effects. We talk about moving household effects. Now, one thing that is not deductible that I want to point out is no meals. So even though you can deduct the lodging for your move, you cannot deduct the meals for your move. Okay, you cannot deduct the meals for your move. There are 3 tests that we want to look at that have to be met. The taxpayer must change jobs. Jobs or job sites. Either way, you have to be changing to get the moving expense. Change jobs or job sites. There is a minimum distance test. It has to be 50 miles or more. 50 miles or more than the distance from your former job, or from the former residence, I'm sorry, from the former residence to the former job site. Okay, to the former job location. And then the other rule is that you have to remain on your job for a certain period of time. Okay, for a certain period of time. So you have to meet first the distance test. There's a distance test that you have to meet. And I like this IRS chart here. We have the former residence, because the rule says that 50 miles or more than the distance from the former residence to the former job location. So we have the former residence and we have the old job. And so if that was 3 miles, then we have the former residence to the new job. So if it's only 38 miles, then that's not 50 or more. So the test was not met. Okay? Your new job location is not at least 50 miles farther from your former residence than your old main job location was. So we got old main job, 3 miles. Now the new job is 58 miles. So in that case, it's 50 miles or more, 50 miles further. So in that case, we meet the test. Your new main job location is at least 50 miles further from the former residence than your old main job was. So 3 miles, and then now it's 58 miles. So we met that test. We met that test. The 38 didn't meet the test. And then the time test, real quick before we end, you may not be able to read this, but I'll read it for you. If you are an employee, meaning you're working for somebody, in order to meet the time test, you have to work 39 weeks. Okay? You have to at least work 39 weeks. If you're self-employed and you make the move and to get the deduction, you have to have you have to meet the 78-week test. Okay, so you have to be in that self-employed status or that job for 78 weeks. Okay, if you're both self-employed and an employee at the same time, then the 78-week test for self-employed person or the 39-week test for an employee. Okay, your principal place of work determines which test applies. So which one is your principal place of work? If you're both self-employed and employee but unable to satisfy the 39-week test, so let's say I'm both, but I couldn't satisfy the 39-week test, then the 78-week test for the self-employed person will work. So you have to meet the distance test further than 50 miles, and then you have to meet this time test, 39 weeks, okay, which is a little less than a year, and it's over a year if you're self-employed. It's over a year if you're self-employed. So that is moving. So you have 3 tests. You cannot get meals, so I can take the travel costs, the lodging, and the moving household effects. I cannot deduct the cost of going to find a new house. I'm just deducting the actual move. So those are moving expenses. So we will stop there. We still have the educational piece to cover in this chapter, and then hobby losses also to cover in this chapter. So continue to read through chapter 5 and continue to work on your multiple choice questions. Thank you.